SoFi Technologies is an American financial company that is currently under pressure and intense scrutiny, and that's exactly why investors should pay attention to it. On one hand, there's a report accusing the company of inflating a key metric, its profit, which creates real tension around the stock. On the other hand, large institutional investors continue to pour billions of dollars into SoFi's business platforms. So what should you do? Buy or sell? And which of these events will have a bigger impact in the long term? If you buy, at what price? And how long should you hold? I'll answer all of these questions in this video. Let's get started. If you're not familiar with SoFi yet, it's a digital financial company that lets you spend, borrow, invest, and even get insurance, all in one app. Unlike traditional banks, you don't need to visit branches or switch between multiple platforms. Behind the scenes, SoFi also operates Galileo, a technology platform that powers accounts for other fintech companies around the world. That's what makes SoFi different. The company earns not only from lending, but also from banking fees and licensing its technology.
Now, let's take a look at SoFi stock. It's currently trading at around $16. Since the beginning of the year, it's down nearly 40%. That's significant. However, over the past year, the stock is still up, so the long-term trend remains positive. But what caused the drop? Most likely, one event. On March 17th, Muddy Waters published a report criticizing SoFi's accounting. It's important to understand that they make money when stocks go down. Their core strategy is short selling.
They accused SoFi of overstating its adjusted EBITDA. What is EBITDA? Earnings before interest, taxes, depreciation, and amortization. Essentially, profit before those expenses are deducted. Naturally, this scared investors. At the same time, the broader market was already moving away from this stock. As a result, fear from the short report combined with macroeconomic risks, and a sell-off began. Most people don't even look into who is making these accusations. A firm that profits from stock declines publishes a report. The stock drops, and that's it. And something tells me Muddy Waters made good money on this. Just my personal opinion. Now let's get to the interesting part. The disconnect between the stock price and the business itself. If the company were truly heading into a crisis, major partners wouldn't be lining up. On March 26, just 1 week after the Muddy Waters report, SoFi announced new partnerships worth $3.6 billion in its loan platform business, LPB. This is an online service that connects borrowers and investors, individuals, entrepreneurs, and companies directly, bypassing traditional banks. Here's how the LPB model works. SoFi finds borrowers, originates loans, earns a fee, and then sells those loans to partners. The partners take on the credit risk. If the borrower defaults, it's their problem. Meanwhile, SoFi retains servicing rights and continues earning revenue. The key advantage is earning without taking risk on its own balance sheet. As for the partners, there's no public information since the deals are private. But considering the size, these are definitely large players. Here's the breakdown of the $3.6 billion. Over $1 billion, a deal with a major bank. Over $600 million, a partnership with a financial insurance group. Nearly $2 billion, agreements with top 5 asset managers. These are institutional players, and they signed these deals right after the negative report came out. And due diligence for deals like this takes months, which means everything was already checked in advance. Now, here's an interesting point. Large financial institutions didn't see any issues, but Muddy Waters did. Sounds questionable, but okay. I don't know about you, but I find that hard to believe. If you enjoy breakdowns like this,
Make sure to like and subscribe so you don't miss future videos. Let's continue. In 2025, SoFi generated $10 billion through LPB. This new $3.6 billion represents a 36% increase to annual volume in just 1 week. That's not small, that's acceleration. Now, what about Wall Street ratings? Citizens JMP raised its rating with a $30 price target. JP Morgan set a $31 target. Needham recommends buying with a $33 target. But more important than analyst opinions is the fact that institutional investors continue to allocate capital.
That said, there are risks. First, execution. The $3.6 billion represents commitments, not cash on hand. SoFi still needs to find qualified borrowers. If they fail, the revenue won't materialize. Second, macroeconomics. If the economy weakens and people stop paying, deal activity could slow down. Third, concentration risk. All $3.6 billion comes from just 3 contracts. If one fails, it could impact earnings. Now let's talk valuation. Forward PE is around 26. Yes, that's above the sector average. But revenue grew 40% last quarter. Fee-based income grew 53%. Growth is projected at around 30% in 2026. At those growth rates, a PE of 26 doesn't look expensive. It may even be cheap compared to other fintech companies. If the share of fee-based revenue increases, margins will improve, making the valuation even more attractive.
The overall analyst consensus is hold. Expected upside ranges from 58% to 140% over the next year. And that makes the situation even more interesting. The business is growing, institutions are investing, but the stock is falling due to fear, not fundamentals. I believe this is a temporary disconnect between price and fundamentals. The noise will fade, the business will remain. That's why SoFi looks attractive, but that doesn't mean you should put all your money into one stock. As for price, below $19–20 looks very attractive to me. I believe the stock can reach $30–35. I started buying this company at $7, $11, and $16, and honestly, I'm planning to buy more while the opportunity is there.
How long should you hold? In my view, SoFi is a company I'm willing to hold for decades, as long as performance remains strong. I'm even willing to pass these shares on as inheritance. Young people today, in their 20s, will get used to this platform, and most of them won't switch in their 30s, 40s, or even 50s. That means user growth and assets under management will continue to increase. Last year, the user base grew about 35%, from 10 million to 13.5 million. Name one bank that delivers that kind of growth. Of course, the decision is yours, but in my opinion, it's a great company at a great price. I think you'll find it interesting. Hope this video was not only interesting, but also useful. See you.